Hello, I wanted to send you a video that I think may be helpful to you. I have been receiving a number of questions, and the general questions range around how to record entries and what they all mean. So I wanted to send you this video because I felt like it might be very, very helpful to you. It shouldn't be too long, but I think it would be essential if you're having struggles trying to determine how to debit and credit and what it all means. What I would like to do is put it all in perspective. So in this particular video, I wanted to just talk about how to understand accounting in light of certain type of organizations, in this case, a merchandising firm. So I'm going to go over the merchandising firm. I want to go over the accounting cycle, talk about how to record transactions, what it looks like when you have financial statements and some entries that you can record. So a merchandiser like Walmart sells his businesses, or his business is basically selling products for resale. They do not manufacture anything. Targets of the world. One example of a merchandise operation is more or less a retailer. So understanding that is kind of important. But more than that, the type of transactions is what's going to make this very easy to understand. Merchandising transactions, which you're going to see pretty much with your patent project. As you know, the cycle of the accounting cycle, we went through that. But again, the operating cycle of a merchandiser, you're going to be purchasing inventory. Inventory is a big deal because that's how you generate your revenue. So you sell your inventory either for cash or for a receivable, and then you collect from your customers. This is just a good idea of what a merchandising firm looks like when compared with a service organization. And pay a lot of attention on the merchandising side, which is on the right-hand side of the screen here, and how you have your revenue and your cost of goods sold. This is going to be important because you're going to be preparing a financial statement for paid and approved, which really needs to look just like what you see here. You're going to achieve your gross profit. You're going to delineate, and I'm talking about each line of expenses going to be shown separately, and then you're going to total your expenses to arrive at your difference, which is the gross profit minus your expenses. So organizations have to value their inventory, and you're going to go over that in a number of chapters. And what happens with inventory is the flow of it coming in, the flow of it going out, and how do you show on your financial statements what the ending balance is. And it really does depend on whether you use a periodic inventory system or a perpetual inventory system. And most organizations, Target included, they are going to be tracking their inventory every single time a sale is made, every time a purchase is made. So it's a perpetual inventory system. So it's going to give you a regular updated inventory ending balance. Again, this is just giving you just what you would see in the real world when you're purchasing your inventory. And you need to get an idea of how it all works. So when we're talking about inventory and how to record purchases, think about it. We are going to say this company is acquiring inventory, and it's going to show the increase of that inventory because inventory is an asset, but we're going to pay it with cash. So you see an entry right here. You're seeing both both asset accounts going up and going down. Asset account that's going up, in this case, inventory, is going to be a debit. When you take that asset and you want to decrease it, it doesn't matter what asset it is, whether it be cash, inventory, or accounts receivable. If that asset is going down, you're going to credit it. And that's a really good rule to remember. Now, there's another entry here when you're purchasing an asset, but you're not going to pay it with cash. You're going to actually pay later. In this case, you're increasing your inventory by debiting it, and you're going to increase a liability by crediting it. Assets are increased with debits, liabilities, and equity and revenues are increased with credits. An expense account is a reduction in equity. When you reduce equity, you have to debit it. So expenses are debited. And this is just giving you some idea of what type of entries you'll see and why they're recorded in the way that they're recorded. Again, when you make the payment, particularly within the discount period, you're going to have to make certain that you reduce your liability for the full amount. And you're going to reduce cash by what you actually have to pay. That difference is going to be your inventory. And again, this is going to be on the perpetual inventory method, and that's what we're assuming in this particular case. Again, when we're talking about an organization that is a retailer or a wholesaler, we are talking about merchandising operations, and these are the type of considerations that one has to make when you make returns or when you have allowances, and how to record those types of transactions. And again, cost of transportation, who bears the risk? And that's a very important question, and your textbook talks about it a little bit, and we don't get too deep into that with regard to your project, but it's very important to note that when a good's in transit, if you want to bear the loss of that, if you're going to bear the loss as a seller, that's going to be a FOB destination. That means it's going to be in your responsibility up until the time it is delivered to your client. So important to make that distinction. And that will also affect how the entry is recorded. So let's just test your knowledge. If you have a transaction on January 1st, you purchase merchandise of $10,000, FOB shipping point with credit turns 210 and net 30. Now, when the seller is going to pay in cash for some items to ship. So let's record the first entry. How would you record the purchase of this merchandise? And number two, how are you going to record on the seller side the freight or the shipping charges? Well, first you want to record your merchandise inventory, and you record an increase in your payable because you're not paying it. When you make the payment, however, you're going to remove your payable, remove the amount of cash that's in your bank account, and the difference, which is at $200, is going to be a reduction in inventory. So when Walmart actually delivers the product to the customer, you're going to pay the delivery charges expense, and you're going to reduce cash. Again, looking at the transactions here, the most important thing to note is try to get an understanding of what is actually occurring. If you can say with your mouth, I am trying to record a sale, that's very important. I am trying to record a purchase. And whose perspective are we recording the entry? Whether it be the seller side or the buyer side. And that's going to be the important question to ask even before you actually lay out the debits and the credits, because that's going to be important. So we are talking about the seller's perspective. Now, what about on the other side of the coin? How do we handle sales discounts? And again, these transactions are not complicated. It's just that you need to remember, when we are trying to encourage our client to pay quickly, we want to be able to make certain that they can do so. And when we do that, when do we record the sales discount, and how do we record the sales discount? And this is a very, very standard entry. The only difference you might see would be the dollar amount. The most important thing is when we're recording transactions on the seller side and we're providing a discount, is going to go into a contra account, which you see here called sales discounts. Now, remember, when we're recording adjusting entries, we need to remember there are a number of things that have to occur. We want to create entries that will zero out our temporary accounts. For example, our temporary accounts include sales, and it also include our expenses. When we're closing out those accounts, we are making certain that those accounts are reversed from the opposite side. So if we are recording our revenue and we're crediting our revenue throughout the month or throughout the period, we have to debit it to zero it out. And the same is true for our expenses. When we record our expenses, we debit them. So to remove them off of our books in the closing to income summary, we have to credit them, and goes on with the remaining dividends, remaining accounts that we have to close. The really critical thing, I think, with merchandising firms is it's just that we have to remember, when we're recording transactions like our sales, and we're recording our inventory transactions, those transactions are very unique to the merchandising firm. But our closing entries are the same for any firm. Our entries to record accruals are going to be the same. It's just those type of entries that are actually a little bit different, which is why we're highlighting them here. This is giving you two types of income statement, a multi-step income statement and a single-step income statement, which a multi-step is going to be grouping them in different areas. Operating expenses, administrative expenses, and gives you your operating income, and then you have your below the line items, which is your interest expense, which is our non-operating expenses and income. So think about how we can provide you with the most value to your reading materials. Ask your questions in the Q&A. Challenge me when you're actually going through your homework problems. They are designed to help you practice these different types of skills so that it ensures you not only understand what you're doing and why you're doing it, but you are accurate in doing so. I really hope that this very short video, gives you an idea of the process by which you'll be working on your patent approved project. Have a good day.